Nike's slogan is "Just Do It," as the whole world knows. But did you know that that strapline was inspired by a convicted killer called Gary Gilmore, who was executed for 2 murders in 1977? And Gilmore uttered the words, "Let's do it," just before he was executed.
The need for something like PayPal seems a lot less pronounced than, say, 10 years ago. The threat of fraud and just the general ability to pay online wasn't as common. I just want to give a quick word from our friends and sponsors at Vodafone Business. I used to think of Vodafone Business as only a reliable provider of mobile and broadband needs, but they're really stepping up to help Irish businesses grow and flourish in an increasingly digital world. So they now offer a whole array of digital apps, from productivity tools and security solutions to IT support and even website builders. More recently, Vodafone have launched their VHub digital advisory service. With its new service, Irish businesses of all sizes can get free one-to-one digital support and advice tailored to their business by simply booking a call with one of the VHub digital experts on the Vodafone Business website. Search Vodafone VHub for more information.
Hello everyone, I'd like to take 1 minute to tell you about a brand new MyWallSt service called Nexus and to invite you to register your interest so you can be the first to hear about it when it launches in November. As you know, AI is changing all businesses, and those who do not embrace it risk being left behind. The product we've created fuses state-of-the-art AI, advanced filtering, and the intelligence of master investors for short, actionable insights. There are over 58,000 listed companies on 60 exchanges around the world, from which just a handful will grow 100-fold or more. Just one is required to change your life. Nexus is built to find it. Had it existed at the time, Nexus would have pinpointed stocks like Monster, Sleep Number, and Biospecifics, all ahead of a minimum 100-fold growth. This is a low-volume product for serious long-term investors. Register now via the link in the show notes or visit mywallstreet.com/Nexus to express your interest.
Emmet, how are you?
Hi Mike, how are you today?
I'm good. I know, yeah, it's taken a while to heat up the house this chilly Wednesday morning. I think Storm Ciarán is outside beating down the door as well.
So west of Ireland is getting a slamming from Storm Ciarán. What's it like over there at the minute?
That's in bits. It's
Really?
like grey, raining sideways, wind hitting the door. Not amazing. Don't tell me it's nice in Dublin, is it?
Look, you're just getting a normal Galway day. It's actually okay. I played tennis at the break of dawn this morning, so it wasn't too bad. We got rained on, but at least we could get out there.
Yeah, okay. Well, it's been a while since it was just myself and yourself. We've had a bunch of interviews recently, so we're going back to kind of a normal cadence, we'll say, for this week.
The OGs, this is where it's at, Mike. The real conversations happen here. I am so unprepared, so literally this is going to be as gun in holster as it gets.
That's good. It's good because it's kind of a riffing enough podcast for theme, I suppose, for this week. Anyways, it's basically, my idea was I took 3 companies and I'm trying to figure, are they value traps or deep value plays? So 3 companies that the market has just chewed up and spit out over the last year and a half, 2 years, we'll say, all hit all-time highs in 2021 and have all been absolutely bet up since, basically. So 3 companies are Disney, Nike, and PayPal. So let me know where you want to start and we can dive in.
How about I start with a little story about Nike? Because this is a good one. So we're recording the day after Halloween. So I'm going to tell you a story that's exactly 51 and a half weeks too early for Halloween, because it's a bit of a spooky story. And as I think we mentioned on the podcast before, I definitely have a soft spot in my heart for Nike, because when I read Shoe Dog, as we discussed on this show before, I just really liked Phil Knight, its founder. Like, he is the Warren Buffett or the Bill Gates of the sneaker world. And the book gives a really personal account of his journey to build Nike. And it starts with him regaling this post-college trip around the world, during which he conceives of an idea of importing high-quality running shoes from Japan. So I think in the book he said he started with a $50 loan from his dad, and he created Blue Ribbon Sports, which of course went on to become Nike. And it's a very beautiful and relatable story, I think. But here's a spooky, not fun fact about Nike. which is, as I said, a little bit early for Halloween, or just a tiny bit late. So Nike's slogan is "Just Do It," as the whole world knows. But did you know that that strapline was inspired by a convicted killer called Gary Gilmore, who was executed for two murders in 1977. And Gilmore uttered the words, "Let's do it," just before he was executed. And Dan Whedon, who's the founder of Whedon and Kennedy, which is this huge, big American global advertising agency, and I think were made famous because of a relationship with Nike, was inspired by Gilmore's words. And he created the Just Do It campaign in 1988. Isn't that pretty spooky?
It's awful. Why did
Yeah.
they advertise it, especially if he's an advertising guy? Like,
Yeah. So I don't think that at the time when they went with the Just Do It strapline that they would have said, "Hey, guess what? A guy in death row said it."
guess who inspired this?
And
Yeah.
it didn't even make Phil Knight's autobiography. And I'd heard that rumor and had to go digging on the internet to actually substantiate it. So you can understand why Phil Knight decided to sidestep that part of
Yeah.
the story. But I just, when I was double checking on it, I thought, oh, yeah, that's very Halloweeny, and it's a good opener for a show that's going to air after Halloween.
That's gas. Because didn't he pay like an art student who made the swoosh like two
Yeah.
dollars and change or something as well? So we've got
Yeah.
somebody paid absolute peanuts for the most like iconic, emblem in sports, and then a convicted murderer coming up with the slogan as well.
But that
Very
reminds me
humble
of,
origins.
yeah, like the rebrand of Twitter. The guy who did the X wrote on Twitter, thought it was or on X. He wrote on X. I spent 10 days working on X, and here are 10 lessons I learned, which I thought was beautifully ironic. Like he literally came in, he drew an X, and he was fired. So he
Yeah.
decided to regale the world with his 10 takeaways from working at X.
All right. Well, let's get into Nike, the stock. And don't want to call it Nike either. I call it Nike in Ireland, but all the
Mm,
Americans will be on the line calling it Nike. So let's
mm,
get into Nike, the stock now. So down about 40%, a bit more from all-time
mm,
highs set in November of 2021. Currently trading at a price to earnings ratio of just over 30. Its 5-year average price to earnings ratio is about 45. So we can see it's definitely trading at a discount. And then the shares are still above their COVID low. So it isn't really seen the same downturn as Disney or PayPal, which we'll get to later in the show. So I think the struggles and why it's fallen has come basically from an excess inventory issue. So post pandemic, so I think it had a not enough inventory over the pandemic. It got exposed, especially for its supply chain in China. Since then, it's overbought and overproduced, and that is always a concern, especially with the apparel companies. We saw that really affect Under Armour over the last, we'll say, 5-10 years in terms of flooding the markets and then becoming discounts and all the rest. And obviously that wreaks havoc to a company's brand, something that's so important to Nike. But I think in terms of the inventory, it's kind of abating. We've seen some very positive earnings reports in more recent times, but there's still the lingering effects on costs, pressure on margins, and then the multiple compression, which we've seen. The other concern we mentioned is the strength of the consumer, especially in China. So China is responsible for about 14% of total revenues last year in fiscal 2023. And this is the region that's kind of come under pressure, we'll say, in terms of the strength of the consumer. And we obviously know apparel and footwear is 100% a discretionary expense. Even in America, we've seen this as well. Foot Locker and Dick's Sporting Goods had two awful earnings reports and brought Nike down with it during the summer. So that's kind of, we'll say, the bear case. Now, we're
mm,
going to discuss Disney and PayPal after this, and their
mm.
issues could be considered a lot more systemic than what Nike is facing now. I think, in my opinion, anyways, this feels much more like a short term blip, we'll say, than anything like inherently wrong with the business, or that could say break an investment thesis. What's your opinions on that?
Yeah, I completely agree. I mean, as you know, Mike, I generally avoid fashion. And Nike, you could say, is on the periphery of fashion. It almost transcends fashion. It is, of course, produces high performance sports where that needs to be fashionable, but it feels like an everlasting brand. And what you described there, which is effectively the inventory struggles that every apparel and fashion maker goes through, is just their roadmap. That's just the gig they're in. And you can imagine that they are far better at it than the next, because you can just think of the resources and the learnings that Nike has had over the last whatever it is 30 years. So yeah, I think when we kind of put a spotlight on an industry or sector specific problem, part of your thinking needs to be, well, they have armies of MBA students thinking about this problem way harder than me to sort it out. And I it's funny, like you're right. I think for Nike and the other two brands, you said Disney, and what's the third one we're going to talk about?
PayPal.
PayPal, right? So certainly Nike and Disney are these kind of American icon brands. They are resourced and paced by the fact that three of them are American icons, and we'll dive. I have some stories about PayPal. Hope I get them right, because I said I'm shooting from the hip here. But they are three mega brands in entirely different areas, and I think they are just what you've described there is just oh yeah, another day at the office for Nike. So when you said, as you were describing their inventory problem, the whole story about Under Armour flooded to mind, and it's really what do they do with excess inventory, because luxury brands usually destroy excess inventory rather than discount it. And I think that that's not something that you would do in the sports world. It just to me, it doesn't make any sense, because you're not trying to uphold a brand value. But I certainly, my natural inclination is to ignore the ebbs and flows of the inventory story for a business like Nike.
Yeah, and just touching on that, like kind of protecting the brand equity, we'll say. So Forbes
Mm,
calculated Nike's brand equity at, it was around $40 billion. So I think it put it at the 13th most valuable brand in the world, up alongside, you know, $1 trillion businesses. And that's actually what's really impressive is Piper Sandler just they do an annual teen survey basically, where they ask teens what they like, what they don't like. Nike was the number one brand in both footwear and in apparel. So not only is it
mm,
built this massive brand, but it's protecting it as well in terms of the younger generations. It's not slowing down whatsoever. And I think that was the
yeah.
problem with Under Armour, especially. We always go back to it because Under Armour shows what not to do with the brand, especially in this space, whereas Nike has done it for so
Mm,
long and exemplary, we'll say. And even now, like, it's not going after maximum revenue, we'll say. It took its products off Amazon. It's not selling at certain stores. It reorganized its relationship with Foot Locker, with other wholesalers, all to protect its cool, I suppose. And that's the one thing I think that we always come back to with Nike, is that it has this brand value, and it protects it so well that it's the real economic moat there that other competitors just can't create. And I think
yeah.
that's why I'm putting Nike maybe aside from the other two, which we'll discuss now, I think. So yeah, I'm
Yeah.
with you there.
Yeah.
It definitely feels like much more par for the course, we'll say. And
As
maybe a good opportunity in terms of buying. It doesn't trade at 30 times earnings very often. I think it hasn't
yeah.
traded since 2017. It hasn't been this cheap. So
Yeah, and as you know only too well at the moment, Mike, we are busy just readying a new service for launch called Nexus, which combines AI, screening, and human intelligence. See, I can't miss the opportunity to plug it, and I think it's going to be the greatest service of its type ever launched. But anyway, I continue to plug. But I looked at Nike in Nexus, and what I found was that it has like this really incredible sustained return on equity, which is very unusual in the industry. Its return on equity at the moment is around 34%. Its return on invested capital has remained more or less at or above 20% for years and years and years, and its sales are growing. And when you take those three quantitative factors and combine them, which is growing sales and a highly capital efficient business, you are ultimately looking at a business that will regress, or sorry, rather revert to the mean. And its mean at the moment, which is its share price is down, is feels to me like a very um, temporary problem, if you like, on a business that's of the highest quality. And you don't need to dive into numbers to know that. I think your average bystander will just look at Nike. And again, comparing to Under Armour, I remember when I invested in Under Armour I would say maybe 15 or 20 years ago. My logic at the time was this is a challenger brand. This, like Nike is the brand your dad wears, and young people want to wear this new up and coming brand that stands for something different. And as time has gone by, initially Under Armour delivered against that. We're the cool brand, and your dad, leave the Nikes for your dad. Whereas it's actually done a complete 180-degree turn. Whereas Nike is now, from my perception, the cooler brand, and Under Armour is that discounted thing in big shopping, discount places like Woodbury Common and whatever they're called.
Yeah, absolutely. And just on that last point as well, management has recognized basically that shares are on discount, so it's accelerated its buyback program at the minute as well,
Oh,
which is always
interesting.
positive to see. Okay,
Yeah,
let's move on then. We have Disney or PayPal. Where do you want to go on it?
I'm easy. Go
All right,
ahead, whatever.
Let's start with Disney.
Okay.
Yeah.
Well, I
All
mean,
right.
who doesn't hold a place in their heart for Disney? Like
Yeah.
like when I hear Disney, I'm just hit with nostalgia. And do you have a whole pile of facts before I basically start rambling?
Yeah, let me go through the
Okay,
numbers of the
shoot the
stock
facts.
now,
Go.
and then
Do
you
it.
can get into
Just do it.
your own bit. So down roughly 60% from all time highs set in March
Ouch.
of 2021. Currently trading. This is interesting. Currently trading the price to earnings of 65. So its 5-year average is 60 there. So it's actually becoming
Hmm.
more expensive, and this is because its earnings are going down because it's spending so much money on Disney Plus and all the rest. Interestingly, though, its price to cash flow is at 19 times. Its 5-year average is 35. So it is still bringing in money, but it's not turning into profit. Shares are now sitting at a roughly 9-year low. So we'll get into why in a minute, but you take the lead there.
Well, as a business, it's really just unreal. Like the vastness and the complexity of the Disney organization is just mind boggling. And we generally assess a business from what we can see. We spoke about Nike and we all interact with the brand. We might see it on our favorite sports star on TV or wear Nike sneakers or their stuff to the gym or whatever. But we interact with a brand with very, very small touch points. And I don't think there's a business where those touch points are as small, you don't realize how small they are compared to the organization size. It's like an ice cube sticking out of the water with the biggest iceberg ever under it. And so it operates through several business units. And really, I don't have this written down in front of me, so listeners will have to forgive me if I miss any. So I know they've media networks, which is all about broadcasting and radio and publishing and all these digital businesses. Uh, the ABC television group, ESPN, they still own ESPN, do they, Mike?
Yeah, yeah,
I think,
yeah.
yeah. Then they have parks, experiences and products, and that's the theme parks, resorts, consumer products, cruise liners. I mean, like
Yeah.
when you take a cruise, a Disney branded cruise, that's just one element of one division of the business. Then they have studio entertainment, which is Pixar, Marvel, 20th Century Fox, 20th Century Lucasfilms. Like just that they own Star Wars alone, that's an empire. Then they have direct consumer, and as you said already, Mike, they have Disney Plus, Hulu. ESPN Plus, I think. Then they have all these overseas Disney channels. They also have a division called Consumer Products, which sells merch and publishing and games. And many years ago, I saw this really nice map of the entire Disney business, and it was shaped like Mickey Mouse's head. And it had all these different studios all over the world that are all concerned with one particular element of their business. And honestly, I just don't think Nvidia is even 1/10 as complex as Disney. It's like the most mind-boggling, complex, far-reaching, multifaceted business you could ever imagine. And again, a bit like Nike, it's one of these everlasting brands that you could decide, I'm just going to buy a handful of shares and leave them to my grandkids in my will.
Yeah. Unless you bought them 9 years ago and died today.
Well,
um,
it's been a couple of rough few years, even for Disney.
well, let's talk about the downturn. So, and it's tough to
Hmm.
know where to start really because there's so much going on. But I
Yeah.
think let's start at the top and we'll go through the succession plan or the botched succession plan where Bob Chapek came in as Iger's successor. No one basically liked him or his ideas. He got the boot.
Yeah.
Bob Iger had to put the golf clubs back in the shed for a few years. He came back. Obviously, one of the greatest business leaders of the last 50 years was Bob Iger, and what he did
Yeah.
for Disney was huge. But since he's come back, he's only really been putting out fires. One of those
Mm,
fires, the most consternation, I'll say, for his sake, is probably Disney Plus and the money pit that's become. And
mm,
I think this is evident across all of streaming, where so many companies have come in, decided to do streaming, pumped millions, billions, I'd say in Disney Plus's case, into the content side of things, and aren't seeing the return on the consumer side. When you charge people $5 and change for a month, like, that's not surprising. And obviously that was the growth strategy behind Chapek, was exponential growth and then worry about the numbers later. But now the numbers are coming home to roost, and
mm.
it's not looking good. So Iger's main initiative now is to make Disney Plus profitable. He's put the price up a couple of times this year, and it's just, I don't know, would that have been his strategy from the start? Do you know what I mean?
Mm.
And I think
Yeah.
that's one of the main concerns here, is that Disney is still hemorrhaging money. It's having to look to sell off divisions. I saw recently it's considering selling off its Indian operations. It's still floating in a sale of ABC. A lot of investors wanted to sell ESPN. I don't think it's going to, but there's so much going on here, and all of this time as well, it's going to have to spend about 8 billion, I think, to buy the rest of Hulu off Comcast.
Oof.
So it's pumping more and more cash into the streaming side of things. So it's kind of locked in there. It doesn't have a choice. It
Yeah.
has to make streaming work. And I don't know if that would have been the most efficient use of its capital. And then that's very hindsight is 2020. But I don't know if Bob Iger could go back to 2018. Would he say, we'll spend all this money on streaming, we're going to have to cancel our dividend over COVID, and we still haven't brought it back? There's so many things going on there that aren't
Mm.
really helping investors, especially in this mindset where everyone is looking at cash flow and balance sheets come under more scrutiny. So just that money sink of the streaming really, really is holding the business back at the minute.
I'd say Bob Iger is sick to the core because he handed over this near perfect multimedia entertainment consumer experience business. It was perfect. He wrote his autobiography, which my son read and told me was brilliant. And then we went to find it, and I couldn't, and we lost it somewhere. And I went to buy it again, and it was gone. And I'm sure, well, I'm not sure. I wonder if Bob Iger is like, damn, I wish I hadn't written that autobiography. There's another 3 chapters to go. But you're right. I don't know if the hole in the boat of Disney is entirely down to Disney Plus, because I am too clear on the financials of it. But certainly, anecdotally, based on what I'm hearing and reading, it is the problem child. And even if you speak again about a consumer experience of just one, so we here in my family home are subscribed to everything. We don't have a dodgy box. We pay for everything. So we're subscribed to Netflix and Prime and Paramount and Sky and Disney Plus and Sky Sports and everything. So whatever, we've stacked them all up, which is a source of frustration, digital frustration, because when you go to look for a show, unless you have a Roku stick, another subscription, you kind of have to troll all is it troll the right word? It's troll all these different services. And I find Disney Plus to be the one of lowest value. I don't find the content to be aligned with my family's interests anymore. My kids are too big for the Pixar stuff. My wife and I aren't too interested in the other programming they've got. It seems that Netflix keeps the content current. It does all these moonshots. Prime is kind of positioned itself around the vast movie content it bought when it bought the studio in Hollywood, and all the others have kind of got a stronger value proposition as far as I'm concerned. So from an opinion of just one from billions, I just think that Disney Plus is not a very good service, and it would be the first that I'd kill if I had to make a choice. Now, is that reflected across the digital service buying world? I'd say it is, to be honest. What do you think?
Yeah, I'd agree. And I think even more problematic issue right now is that in the cinemas, I think this is coming through as well.
Mm,
The Marvel stranglehold that's been on box office for the last when did Iron Man come out? Like late 2000s. So the last 15 years, we'll say. It was the only blockbuster in town. I think that
Mm.
influence is kind of weaning now. I think the
Mm.
post, we'll say, the Avengers era of Marvel isn't connecting the same way it has with audiences before, and that's a major concern because these were all billion-dollar outlays. Basically, their last three big movies, I think the Avengers movies and that Spider-Man one, were all three of the top seven movies to ever come out. And
Mm.
I don't know if that cash spigot is being, I won't say turned off, but definitely turned down. And
Mm.
obviously, this is being affected by short-term issues like the writer strike and the actor strike as well. But I genuinely think it's a cultural issue where people are looking for real movies now. They've been criticized for so long, and amongst actors and directors, obviously, because it's eaten into their profits. But the kind of criticism of, oh, it's just another superhero movie. I think
Mm.
people are kind of losing their touch on that, and I'm not surprised, and I don't think it's a bad thing either, as someone who enjoys film and TV.
Yeah, it's true. I mean, when you look at the way they've extracted value from some of their assets, like the Lucasfilm, the Star Wars franchise, like they've trashed that to bits. I don't think there's a story left to be told or a character left to be highlighted. And there's going to be a long lifetime value in the Star Wars franchise. It's going to deliver multiple fold of whatever they paid over the next 40, 50 years. But I don't see there being much left for them to do in the short term with that family of assets. I think that of all the, let's say, film producing assets that they've got, I'd imagine Pixar is the one with the longest shelf life because it can produce something truly original as fast as I suppose their studios can deliver it.
Yeah, one struggle with Pixar, especially when it comes to box office, is that they've created this cadence where people basically know that it's going to come out on Disney Plus in the next few months anyway. So why would we bother going
Yeah,
to the cinema? So
yeah.
it's kind of shooting itself in the foot there as well. In terms of, we'll wrap up Disney now, but again, we're going into this problem of like systemic issues or investment thesis, investment thesis breaking issues.
Mm.
I think Disney has so much more to fall back on that I don't think I could put it into that bracket. I think the sell off is probably maybe not exaggerated, but maybe has momentum in terms of, we see a headline every couple of months, Disney at 6-year low, 7-year low, 8-year low, now at 9-year low. And that sell off is kind of feeding into it. And activist investors who got on board, Nicholas Peltz is there, he's looking for board seats, making Bob Iger's job even more draining, we'll say. And it definitely needs a turnaround, and we're going to see a lot of assets being sold off. But I have a lot more faith, we'll say, in Disney doing that. I think the
Mm.
IP there, the parks and cruises and entertainment, that's that backbone, the cash cow, it's always been called. So it's almost an insurance policy, and then it can figure out the rest. And it's going to rejig. It's going to rejig its consumer facing side and maybe lay off ABC, lay off its Indian operations. Probably invest heavily into Hulu because it has to, because I think it's on the hook for about 8 billion for Comcast. But but I have a bit of faith that it's capable of all that, and it won't be a short term turnaround. It's going to take a good few years, but it's there to be done. Does that make sense?
Big time. I mean, you're right. This is the most diversified media company you could ever imagine. So you're right. There are problem children, if you like, and whether it's Disney Plus or the cruise liners or theme parks need a facelift. Again, just as we discussed with Nike's inventory, these just go with the industry they're in. There's consumer taste cycles. They have at the moment Disney, their capital efficiency is quite low compared to historic data. Like the once upon a time, they had a return on equity that was constantly above 20% all the way up until 2018. Then it started to fall, and it's now in the low single digits. It's around 3%. So the business is not capital efficient at the moment. However, you can, again, we've Bob Iger at the helm. We have a team of MBAs there to figure it all out, and they will figure it out because there's no one part of that business that can drag it down. And ultimately, it has the ability to divest the underperforming parts of its business. We just have to see how and when that happens.
Yeah, and it can always fall back on the parks and cruises for that cash injection when it needs to too.
Yeah,
Okay,
every day.
All right. If you are on the hunt to find the next Disney or Nike, you're going to love reading our newsletter. So we're delivering to your inbox one of the most unique products on the market. It's completely free, and no one else is covering the markets we're covering. So Charging and Fearless will be deliver to you a new weekly stock pitch that could be from Amsterdam, Tokyo, Paris, or somewhere in between. So a completely free stock pitch every week. You'll have it read in about a minute flat. I mean, you can almost guarantee most of these companies are going to be brand new to you, which is where you get an edge. So sign up now in the show notes for this episode. All right, Emmett, we're going to finish off with PayPal. And I brought up this systemic issue concept a few times, and I think this is probably the company that may be facing that the most. So, quick run through: down more than 80% from all-time highs set in July of 2021. Currently trading at a price to earnings of 14 and a price to sales of 2. Its 5-year average price to earnings is 54 and its price to sales is 8. So that kind of gives an example of the multiple compression and how far down it's come. Share sitting at around 2017 levels when the company was about a quarter of the size, we'll say. So PayPal, like most of tech, was flying over the pandemic. As you can see, obviously it's an e-commerce payments processor that's going to work when no one can leave their house and everyone's ordering online, but its hangover seems to be a lot worse than most. So obviously kind of nearly every company went through this boom bust cycle of rapid growth to slowing growth, outsized costs, pullback, uh, job losses, cost cutting, whatever else. But that doesn't really tell the full story here with PayPal. So I think increased competition is a big one here, especially on the consumer facing side of the business. And it's led to active accounts falling. And it looks like the business might even be pivoting a bit more to the merchant side of things with its BrainT product, which is kind of a competitor to Stripe and Adyen. Because we can talk about this anecdotally here, and we look at the Peter Lynch style of investing. When's the last time you checked out with PayPal?
It's hooked up to the Sony PlayStation 5. So when something is purchased on it, that's when my household uses it. But other than that, I don't see it integrated into my everyday life. What about
No,
you?
same. And I think it's tough to look at this because it's very anecdotal and it's my experiences, but I've seen checkout with Apple and Google Pay 10 times as much as I see with PayPal now. And it's so much easier as well. It really has been caught up, we'll say, with the other competition, and it feeds into this concept that payments processing especially has become a bit commoditized
Yeah.
as an industry. So we're seeing this across a lot of the businesses in this industry where multiples have fallen off a cliff, competitors are flooding the market, and then take rates and basically your piece of the pie gets smaller and smaller. So Adyen was a big one there. It was cut in half when it released the poor earnings report for Q2. The European payments company Worldline last week fell by as much as 60% in one day. It was
Wow.
blaming macro conditions significantly slow down its business, and it's basically citing fear amongst other payment companies. Since we go back to Nike there, where we're talking about discretionary spending, e-commerce spending is 100% discretionary spending for most people. So if we see a pullback in spending and a weaker consumer, PayPal is definitely going to suffer there. And then just this is more conceptual, but the need for something like PayPal seems a lot less pronounced than, say, 10 years ago,
Oh
where
yeah.
the threat of fraud and the ability, just the general ability to pay online wasn't as common.
Hmm.
And I'm not sure. I don't want to be too harsh because I think the underlying numbers aren't as bad as we'll say the conceptual side of things. But is there a valid question that is PayPal's business model in peril?
Yeah, it's very valid. And when you look at whether it's Paul Allen in Y Combinator, or when you look at where the money is going from venture capital firms, which is the next step up from Y Combinator, and when you look at the stream of businesses that are now floated on the stock exchange, which is downriver, there are more payment providers, payment solutions, payment processors, the plumbing of payment than ever before. It's absolutely such a crowded space, and even when you look at the seed investment sites in the UK and the US, like Republic and Crowdcube and Seedrs, there's always some kind of payment solutions provider on a raise. So definitely it's a highly competitive market. But what I think an awful lot of listeners, and again, going up 40,000 feet, what I think a lot of our listeners probably don't realize is there's probably no business in the history of business that's had a greater impact on the world's how would we say, digital zeitgeist or its online zeitgeist. Like the impact of PayPal on the entire world of
Yeah,
commerce
you're
is
going into
beyond
the
belief.
PayPal mafia, is it?
Yeah, exactly. I mean,
Yeah,
that's
yeah,
one of the angles. I mean, these Silicon Valley luminaries known as the PayPal mafia, they set up companies after working in PayPal or after being a founder of PayPal, such as Tesla, guess who? LinkedIn, Palantir, SpaceX, Yelp, Yammer, Slide, Affirm. Like the number
yeah.
of
I think
companies
you
come
could
out
give
of there.
Facebook a bit of credit there as well, because like wasn't Peter Thiel? I know he didn't
Peter
found it,
Thiel,
but
yeah.
he was right in at the start, you know.
You bet. I mean, you could also give like in 2005, two guys who are not part of the PayPal mafia, Chad Hurley and Steve Chan, founded YouTube. I mean, come on, why can't they be in on the PayPal mafia crew? They should be allowed. I think there's 14 in the PayPal mafia,
Yeah,
and those 14 people plus the two lads who founded YouTube effectively launched, I would say, at least half of the top 20 largest digital slash new age businesses that the world has ever seen. And there's so many chapters to the story, and we all know about the Twitter rebrand. And I was talking about the guy who did the X logo, but originally PayPal was a money transfer service offered by a company called was it Confinity? I think it was Confinity, and it was acquired by X.com in 1999, which, if that sounds familiar, is obviously something that Elon Musk nurtured and kept in his heart
yeah.
right through to
That's
today.
why PayPal kicked him out. You know, he wanted to change the
No, I
name to
didn't know.
X.com. He's been trying to make X.com for 25 years.
Uh,
Yes.
yeah, I'd heard that somewhere along the way, but there's so many stories about Elon. You just kind of end up. It's just this constant stream of stories. It's
Yeah.
amazing how quick. But yeah, so to your point, anyway, PayPal today is sitting in the most competitive battlefield I think imaginable, but it's a very profitable competitive battlefield. And even now today, we were talking earlier about return on equity and return on capital for the other two businesses, but PayPal is its return on equity is 20%. It's a really capital efficient business. It's just that
Absolutely. Yeah.
it's the cash in the register, its sales is pretty flat, and you can see why.
Yeah. Well, the stock market's a forward-looking entity, so it's not really taking into account the current balance sheet, but maybe what it's going to look like in 5 years. And with these
Yeah.
competition concerns, it's hard to ignore. But I do think we have to check in on the numbers a small bit. So it's sitting on 10 billion in cash and it's taking in about 5 billion in free cash flow a year. So it has the opportunity to maybe relinquish its status as a growth stock, become a very shareholder friendly business and buy back
Mm.
stocks, you know, up its dividend, be savvy, reduce costs, and have the shareholder at the forefront of its thinking. And I think that would definitely boost its at least its valuation in the short term. I'm not sure if it's maybe the best long term strategy, but I think it's got a bunch of activist investors on the board. So there'll probably be pressure there to be shareholder friendly in the short term, especially considering just how far it's fallen. And like I don't think it hasn't been mispriced in its history.
Yeah, that's right. It's amazing, a brand that was once the challenger brand that created a solution for a problem most people were facing, which was this new thing called the internet, where you needed to exchange money, has become an old world digital brand, and it's now
Yeah,
looking. It has a like PE, like a real old world PE of something like 14. And you're right that when you look at the numbers, you realize this is just a mature business that needs to, I think, protect what it's got for a start and try and grow into new areas. And I don't know whether they're, I think when you go to purchase, you don't get too high and mighty about what brand you're using. If you go to a register and you see pay with Stripe, I think you feel no different to if it said pay with PayPal. It's a utility. You just do it. So I think when they went and acquired Venmo and then all these other companies they acquired, they're really trying to just, I suppose, broaden their reach as opposed to acquire a cool brand.
Yeah, well, Venmo is an interesting point as well because we're talking about a mature business. I think it really fumbled the bag there in terms of Venmo was there first. It had obviously the P2P payments. So that was a huge opportunity to be the first digital wallet because you're already there in people's minds and on people's phones. You
Yeah,
know, I think if Venmo, if they were on the ball with Venmo, it would look like Revolut today, or even Google Pay and Apple Pay. Like Google Pay and Apple Pay wouldn't have had as easy a run as they did if Venmo was doing what it should have been back in 2016,
yeah,
2017 when it had that critical mass.
yeah.
So yeah, there's a new CEO. New CEO came in from Intuit in August. So it's very early doors to be talking about it now, and I think maybe we give them that potential to have the opportunity to turn it around. I think earnings are coming out this evening, which is probably the day before the day after that. Sorry, the day before this podcast comes out. So we might be looking quite foolish in the space of 2 days. But yeah, there's an awful lot to work with PayPal, and I would be very wary before I would start looking at the value there that has to be
Mm.
unlocked because there's an awful lot to do. Maybe a short term play. Maybe if the new CEO, as we said, gets very shareholder friendly. But yeah, I'd be very wary about its long term prospects. I think it's so competitive, and I think it
Mm.
missed the boat on some key aspects. Venmo being one of them in that digital wallet space.
So let's stack rank the three companies we discussed: PayPal, Nike, and Disney. And the question that I'm going to ask you, and then I'm going to answer for you, is if you had to invest $5,000, no, if you had to distribute $10,000 amongst those three stocks and hold it for 10 years, how would you distribute it?
That's a good question. I'd sleep easiest with my money in Nike from these levels.
Yeah,
Um, I think I'd go 5 grand in Nike. No, I'd go 6 grand in Nike.
yeah,
I'd go. I think I go 2 and 2. Then I think PayPal probably has the most potential, but also has the most work to do. And I think there's a relative safety, like we said with Disney, in terms of the fallback in the IP and just how deep a business it is. But yeah, 622 sounds good to me. I think. What about you?
yeah. I would go half into Nike, 5K into Nike, and then split the 2.5 grand into PayPal and 2.5 grand into Disney.
Yeah, and the PayPal investment is probably the most risky and dangerous one there, but
Mm.
also the highest potential because I think if it does manage a significant turnaround, I'm not sure where that would come from. Possibly focusing on the merchant side and the Braintree side of the operations, but if it does do that and even reaches like a PE of 22 or something, that's already a 50% gain if everything else is the
Yeah.
same. So there's probably the most potential for a quick turnaround there. So
I
yeah,
find it, do you know, just a point of interest, Disney and Nike, from a market cap perspective, are almost the exact same size. They're both $150 billion businesses, which I don't know why I find that interesting, but I do.
yeah, well,
And
that's what PayPal used to be before its
this is
big
true. And now
fall.
it's a $56 billion business. So,
Yeah,
roughly
yeah,
speaking, PayPal is about one third the size of either Nike or Disney, which has no bearing on anything really, other than just it is still a mega brand. And as you said, it used to be as big as Disney.
yeah, absolutely. All right, that was a good show. I enjoyed that. A kind of
Me
bit of
too,
a
Mike.
off the
We,
cuff riffing.
we should never prepare again.
I don't think anyone wants to hear that from us. What are we talking about
Okay.
today, Emmett? I don't know. What do you think? Nuclear? You ever heard of nuclear?
Okay, well, I'll tell you, that's our new formula. And it's great to be back with the OG. This is it. There was an organic show. We managed to talk about stuff without having to think about what are we going to talk about with an
Yeah.
intelligent person.
Yeah, no, I enjoyed it too. All right, we'll finish up there. So before we do, though, I just want to give a quick word from our friends at Vodafone Business. Vodafone have recently launched their VHub digital advisory service, offering Irish businesses of all sizes free one-to-one digital support and advice. You don't even have to be a Vodafone Business customer to avail of this service. So search Vodafone VHub to book a call with one of the VHub digital experts, and we'll leave a link in the show notes for today's episode. Emmet, thanks for joining me, and thanks everyone for listening in. Remember, if you have any questions you'd like answered or elevated pitches you'd like us to tackle, make sure to get in touch. You can find us on Twitter at MyWallStreetHQ, on TikTok at MyWallStreet, or simply just email us at pod@MyWallStreet.com. If you're enjoying the show, leave us a review and share us with your friends. And that's it. Thanks for joining us, and we'll talk to you next week.